from Financial Streams. I'm Michael Harvey and here with Andrew.
Hi Michael.
And this month we're going to talk about superannuation, which is sort of a big topic.
Yeah.
But we thought we'd just cut it back to the basics and just start from the grassroots and build our way up again.
Yeah, that's right.
Because it's such a large topic and you could go in many different directions. So
that's right.
Yeah. So superannuation, what is this? What's the basis of it, Andrew?
Super's obviously to accumulate for your retirement, based on what the I suppose the government's emphasis has been. So you're not relying on the government for handouts as much. So they give you tax incentives to build up funds over time, and so the major piece for planning is the fact that super's taxed at 15%.
Yeah, so let's unpack that a bit more. So superannuation as an incentive, the government has a lower tax environment. So that gets taxed at 15% for both the contributions, money put in by your employer or yourself,
correct,
and the earnings on that, on those funds, compared to, if you're an average salary and wage earner, you're probably paying 35% marginal tax rate. So that's the incentive that you, for any dollar you put in, you're getting a 20 cents or thereabouts benefit.
Yeah, 22 cents.
Yep.
Yeah. 19, depending on your tax, of course.
Yeah.
So that's the incentive, but there's always the rules around it, and then you've got competing cash flow reasons as to why you only, you may not put as much in to super on an annual basis as in previous years. So.
Yeah, so it probably gets back to where you're at in life and what other commitments or plans you have, because on the face of it, from a pure tax perspective, it would make sense to maximise your superannuation, which currently is from what they call a concession or pre-tax perspective, you can contribute up to $25,000 per year, which is inclusive of what your employer puts in, so just be careful. People get caught sometimes that they think it's just what they put in. That's to go to $27,500 from 1 July this year, I understand.
I believe so,
So to maximise super makes sense from a tax perspective, but then there's a trade-off because you can't access that. It's there for your retirement. You can't sort of withdraw it. We'll leave the COVID-19 sort of emergency withdrawals that were allowed last year for COVID. That's just a once in a lifetime event. Ordinarily, you can't withdraw those funds until you retire. So the trade-off, and the common question often people will ask is, do I pay off the mortgage, do I put more into super? That's what I see, around the traps is what the trade-off is, and that's just an individual question that people go to yourself to get sort of advice or to unpack what those numbers look like.
Yeah, and often it's not an easy one. It's like, that makes sense, and yes, it makes sense to do contributions as well. I think it's more around life stages and where you're at. Ideally, I think with contributions into super, we know that our employer puts in 9.5%. It's going up to 10% at the middle of this year. And ideally, there's a lot of rule of thumbs, but if you look at it, contributing up to 15% of your income over the term of your working career probably gets you to the right number.
And that rule of thumb's based on your gross income or your take-home pay?
Take-home pay.
Right.
And obviously, and so getting a little bit more in every year, and I work off if you can aim for that, if you can put in an additional 5% of your own.
So the employer's putting in from 1 July this year, a mandatory 10%.
Yeah.
And so you're saying, ideally, the individual put another 5% to take it to 15%.
That's right. And when you're a young family and you're contributing into superannuation and you've got a big mortgage, especially these days, it's a good idea to pay down debt and also put money into super at the same time.
Yeah.
I always have a view that as you get on top of your debt and you've got more capacity and you've got more ability to pay into super, then you ramp it up later on.
And people can probably see the finish line, I suppose, as you get older. You can sort of see your retirement years coming at you, whereas in the early days you're starting off with a family, it's like a lifetime away. So
Yeah.
hard to see the compounding effect of that extra money you're putting aside each year in super.
Yeah. The other reason I think about that is when you're a young family, let's argument's sake, say you're earning say 70 grand a year. You're getting paid, roughly 7 grand a year from your employer, and you're putting in an additional $3,500 a year. If you do that, and then you've got a young family and you've got a mortgage, and you've got life insurance as well, you've got things coming out of super as well. So you've got to also make sure you accommodate for what I call the drag on your super balance, which is the insurances, the fees, the costs, and so forth that happen to come out of the account. So putting money in assists with that, and then you're really reliant on getting growth over time from your returns. But that helps you just keep that going in the right direction. Ideally, if you can put in more over the life of your working career, and you do that year on year, and you make hay when the sun shines when tax deductions are available to you, that also can help as well from that point of view. Yeah.
So let's unpack a couple of things. I suppose starting from the basics again is one, to make sure your employer is doing the right thing and not the wrong thing by putting the 10%.
Yeah.
I think there's been a couple of really great enhancements in the last couple of years, or 18 months. One is most employers now are in single touch payroll, so it's every pay run they're notifying the tax office of the super, and so therefore with people logging on to say their MyGov account, they've actually got visibility on what their super contributions have been. That's been a little bit murky in the past, where on a pay slip it might have said superannuation's going in, but it actually wasn't hitting the superannuation account necessarily. So that's the first point, is if you've got a MyGov account, to log on and making sure that your employer's doing the right thing. Or you can grab your statement off your super fund and just make sure that there's at least quarterly contributions going in there. That's what's mandated under the superannuation guarantee. The other one is to make sure that you've pretty much only got one account. There's exceptions to that sort of rule of thumb, but often people start a new job and start with a new employer and a new super fund, and they end up with 4 or 5 different accounts or something like that. Once again, there's great inroads been made in the last sort of 18 months, just for people to be able to log into MyGov or other I think it's another website where you can pick up lost super and just sort of see what other super accounts you might have, and generally speaking, to consolidate those into one fund for nothing else, and keeping it simple and trying to keep track of what your super fund balance is a good rule of thumb there.
Yeah, as a financial planner, I wouldn't recommend clients do that without seeking advice.
Yeah.
The main reason is sometimes you have insurances attached to it, and also I can understand your emphasis and your thought about consolidating into a single fund, and it makes sense from simplicity point of view. But then there's the rules around what we can and can't do, and so from an advisor's point of view, we need to understand the costs, and if there's any insurances attached with it, you might be rolling out of an insurance fund that has a benefit, and you should potentially be aware of that benefit before you do that rollout.
Yeah.
So I'd encourage anyone who's considering that just to have a discussion with an advisor on that.
Yeah, so certainly looking at your insurances to make sure you're not going from a good position to a bad position on that.
Yeah.
I just see, I suppose from an anecdotally disinterest in people's super, as we saw last year with the amount of withdrawals. Bear in mind that there was a lot of legitimate purposes, but some of the anecdotal conversations or comments were, it's not my money sort of thing, I might as well grab it and put it in my bank account. And so, just try to get a handle on what balances you've got and seek the advice if you need to to streamline that, so you've got a handle on that. The other aspect I wanted to talk about is probably, you mentioned there about performance or investment returns. So there's probably two aspects there. One is the type of superannuation, what's the right word here, risk profile, or the typically in a super fund you have growth, conservative, balanced fund type of configuration.
Yeah.
And so it's important, I suppose, people get their head around that to then try to at least match where they're at in life to the risks involved. So the two extreme examples in my head would be if someone's about to retire in 12 months' time and they're in a high growth, high risk portfolio, that's just potentially ending tears, because volatility could be plus or minus 20%, if you've got funds invested in the share market or more. So could end in tears, and therefore then on the reverse side, if someone's 18-year-old is starting out, it's another 30, 40 years before they retire. For them to be in a cash only or really conservative fund, doesn't make sense. So not trying to say what you should do, but just get a handle on where you're at in life, I suppose, and what type of mix you are with your super.
Yeah, and I suppose for me, for an example, I met with a couple in their 50s during the week, and I looked at their investments. That they had a couple of different super funds each, and that's because they've been accumulating through work arrangements. One fund was moderately conservative in terms of its returns, and then the other fund was more of a balanced fund. So they had a mismatch already on what they're actually investing in. When I actually lifted the bonnet and had a look at the actual returns, the funds weren't actually performing particularly well. And for the type of asset allocation that they perceived that they were in, it wasn't really stacking up. I think that sometimes it's not a set and forget strategy where you just headlong into an venture and you hope that the fund manager's doing the right thing and you're getting the return that you're expecting over the period of the journey. You do need to have a look at it, and it just highlighted to me that people can leave their investments for a long time without making any changes, and they just miss out on returns.
It's getting the right balance as well, because some people make comment to me that my share super fund's tanked, and they're looking at it on a daily basis, and I just go, how many more years do you retire? And they say, 20 years. Well, why bother looking at your balance on a daily basis when it's 20 years? Get your basics and fundamentals right. And so, not set and forget, but check in on an annual basis, something like that. Is that the right mix for you in life and where you're heading? But don't worry that the share market's 4% down today or tomorrow or whatever, and your superannuation balance has been affected. So it's getting that right balance of getting the right strategy, I think, and then just not forgetting about it and waking up in 15 years' time and go, hold on, I've just left some money on the table by not selecting the right profile or investment profile for where I'm at in that stage of life. So, I mean, everyone gets busy, I suppose, and that's probably where people like yourselves come into play. That some people need to have that annual check-in, and others might be 3 to 5 years is the right time frame early on, and if the retirement's a fair way down the track for them. But just be aware you're leaving money on the table. The other one I just want to quickly mention is just fees, because that's where sort of the industry funds has done a very good marketing campaign about the difference between, say, a retail fund and an industry fund, and purely on same performance and the lower fees. And the message has been very clear, and it's a legitimate message. Just I suppose our warning or encouragement rather than warning is to get across what fees you are being charged, and there's a range of other products that may be available and coming onto the market every day, and just recently the amount of people investing in exchange traded funds, ETFs, and they're quite variable at low costs. And then you've got an index fund that's been around for ages, such as Vanguard. Once again, it's low cost. It's just going to perform at whatever the market's at, but it's low cost. So I suppose my message is that there are to get across your fees, and it does make a difference. But it's too simplistic to say an industry fund is going to beat other options that it might be in the marketplace at any point in time. So I suppose that's the point. And I'm not trying to bag the industry funds, but just people be aware that yes, the message is clear that fees are important. So I suppose be conscious of that.
Yeah, and I suppose if you roll back, say 10, 15 years, there was probably a difference in pricing between some of the retail providers and the industry funds, and the industry funds milked that for as much as they could. But there isn't any longer.
Yeah.
You look at some of the cutting edge super funds and technology that we've got access to it, and there's no difference.
Yeah.
Then it comes to the underlying investments, what you're actually investing in, and so forth. And there is a big difference.
Yeah.
I mean, not every super fund and I suppose portfolio that you have in place is like for like.
Yeah.
I suppose the only similarity, I suppose, is that they're in the super environment.
Yeah.
And that comes down to, I suppose, professional judgment and what you choose to invest in as well.
Yeah.
But most people get the message on keeping fees low.
Yep.
Yeah. And that makes sense to me. If you can save 1% in your fees, then it's 1% better return.
Yeah.
Makes sense. But then there's different tools that you can use, and like you mentioned, there's exchange traded funds.
Yep.
There's index funds that you can use if your whole priority is to keep costs down and you've got a long term view. That makes a lot of sense.
Yeah.
But then if you do value some of the I suppose better managers, and they can still get really good results at a reasonable cost.
Yeah.
As well, so it's something really you need to peer under the bonnet and have a look at.
Yeah, no, that's a good point. Any final comments, Andrew?
In terms of asset allocations, which probably confuses people, but Michael, you're talking about you're conservative, you're moderate, you're balanced, and your growth and your high growth options, which a lot of industry funds have a ticker box, and you go into that. I suppose overarchingly they're designed to target a potential return. Yeah, and that's in my mind quite an important piece, because that gets you to where you want to go.
Yeah.
If you're getting your 7 or 8, your 9% returns every year, you're taking on a little bit of volatility. You're actually going in the right direction.
Yeah.
So if you're in a mismatch, like I was mentioned before, where you're only getting a 3.5% return, you're only really just keeping up with inflation, and you're not getting ahead.
Yeah.
And that's where seeking advice, seeking an understanding of how things are set up properly for you, and keeping that that focus for the life of your investments, will get you where you're going. That's what I'm trying to say. But, it's something that I suppose advisors do well.
Yep.
And it's probably not a message that the public hears a lot in terms of what we do.
No.
Yeah.
Good message, thank you, Andrew. Well, we might wrap it up there about superannuation basics, and it is important. I mean, from 1 July this year, 10% of your wage is going to be put into a super fund for you. Plan to go to 12% over the next couple of years, next few years. So it's going to be a significant part of your investments going forward, and continue to grow. So hopefully it's given you some information to get on top of your super and make better financial decisions. So thanks, Andrew, and we'll catch up again in a few weeks' time.
Thanks, Michael.